Okay, let's jump right in. We're diving into Chevron's third quarter 2025 earnings straight from your sources. The mission today, get you the core financials quickly, especially that earnings beat, and unpack what the forward guidance really means.
Exactly. We need to hit those hard metrics
Yeah.
and what they expect next. Because, I mean, this quarter was a real balancing act for them.
How so?
Well, they're absorbing the Hess acquisition costs while, dealing with lower oil prices. Execution is absolutely key here.
Right, and looking at the numbers, they really delivered. Reported earnings were $3.5 billion.
Yeah.
That's 1.82 part per share. But the adjusted number, the one Wall Street focuses on, came in at $3.6 billion, 1.85 per share.
Yeah, and that easily beat the consensus estimate. Was it $1.68?
$1.68, yeah, so a decisive beat.
A clean beat. And revenue helped too, $49.73 billion, just edging out the expected $49.01 billion. But we do need the year-over-year picture. You got to remember, 2024's market was pretty different.
True, so how did it compare?
Well, reported net income was actually down 21% compared to Q3 last year.
Yeah.
They did $4.49 billion then.
Okay, 21% down. So what drove that? Was it just the market?
It was really two main things. One, external pressure. Brent crude averaged around $69 a barrel this quarter.
Right.
Last year, same quarter, it was $80. So that's a big hit right there. And then internally, they had a $235 million charge that was for severance and transaction costs tied directly to integrating Hess.
Ah, okay. So lower prices plus paying the integration bill.
Exactly. They're funding future growth while navigating a tougher spot market.
But even with those costs, they didn't seem to let up on capital allocation, did they? Shareholder returns look strong.
Not at all. They returned a huge $6 billion to shareholders just in a quarter.
Wow.
Yeah, $3.4 billion in dividends and another $2.6 billion buying back shares. That's management basically signaling, look, we're confident we can handle these costs and still return cash. Shows real belief in their cash generation.
Which brings us right to cash flow. If they're returning $6 billion, they must be generating a lot more. What did CFFO look like?
Cash flow from operations, CFFO, yeah, that was $9.4 billion.
Okay.
And if you strip out working capital changes, which can be a bit noisy quarter to quarter.
Right, smooths it out a bit.
Exactly.
Mm-hmm.
Then CFFO was $9.9 billion. And here's the really interesting part. That $9.9 billion is up 20% compared to Q3 last year.
Up 20%. But didn't you just say Brent was $10 lower?
Yep, that's the point.
Yeah.
Despite a $10 lower price environment, cash flow ex working capital jumped 20%.
How do they pull that off?
Yep.
Better efficiency, lower costs.
It's got to be a mix. Operational excellence, definitely. Getting those cost savings programs working faster, maybe. Plus, strong performance from the base business, keeping downtime low everywhere. Places like TCO and Kazakhstan are key there. It suggests they're producing cheaper and more reliably and probably getting those Hess synergies faster than planned.
And that strength flows through to adjusted free cash flow, too, I assume.
It does. Adjusted FCF, that came in at $7.0 billion, which is up roughly 50% from a year ago.
50%? Wow.
Yeah, and a good chunk of that boost, about $1 billion, came from the first loan repayment from their TCO affiliate.
Yeah.
So it's cash coming back from a partnership, boosting liquidity.
Got it. Now, what about spending? Capital expenditures. Did integrating Hess blow out the budget?
Doesn't look like it.
Huh?
Total organic CapEx was $4.4 billion for the quarter. Now, that is higher than last year, but they flagged that. It's mostly immediate spending needed on those legacy Hess assets to get them humming.
Makes sense.
But crucially, they stuck to their full-year guidance. Inclusive of Hess, they still expect organic CapEx between $17.0 and $70.5 billion. So they're managing the spend within the plan.
Okay, strong financials, solid cash flow, disciplined spending. But it all starts with getting the oil and gas out of the ground. Let's talk production.
And the numbers there were, well, record-setting.
Yeah.
Worldwide production topped 4 million barrels of oil equivalent per day. 4.1 MMBOED, actually. That's a jump of 21% compared to Q3 last year. Huge increase.
And U.S. production was even stronger, relatively speaking.
That's right, up 27% year over year in the U.S. Now, obviously, the Hess deal is the big headline driver there.
Right, you can't ignore adding Hess's volumes. How much did that contribute?
Hess added about 495,000 barrels of oil equivalent per day, MBOD. And management's saying the integration is on track. They're seeing synergies already, and asset performance, especially in Guyana, is apparently better than expected.
Okay, so operationally, Hess is delivering, even with those integration costs we talked about hitting the financials.
Yeah, it seems that way. The volumes are there, but it wasn't just Hess.
Ah, so legacy Chevron pulled its weight too.
Absolutely. Legacy Chevron assets added another 227 MBOED of growth. That came from strong execution in their core areas. The Permian, Gulf of Mexico, TCO again, they keep delivering. Plus, they hit a milestone with the Ballymore tieback project, reached design capacity ahead of schedule.
So it's organic growth plus the M&A boost leading to that record.
Exactly.
And we should probably mention, while they're setting hydrocarbon records, they also hit a milestone on the new energy front.
Good point. Yeah, they achieved first production at the ACES Green Hydrogen project out in Utah. It's small potatoes compared to 4 million barrels a day, obviously, but it's a tangible step. Shows that diversification isn't just talk. And looking at how the different parts of the business performed, you really see the value of their integrated model this quarter.
Okay, break that down. Upstream versus downstream.
Right. So upstream, the exploration and production side, their adjusted earnings actually decreased compared to last year.
Despite the higher volumes.
Despite the higher volumes. You just can't fight those lower crude prices. That $69 Brent really hits realizations, even with more barrels coming from Hess, Permian, and the Gulf.
Okay, so upstream took a hit from prices, but downstream.
Downstream was the hero this quarter, specifically U.S. downstream. Their adjusted earnings were up over 300% year over year.
300%. From what to what?
They went from $146 million in earnings in Q3 2024 to $638 million this quarter. Massive jump.
What drove that surge?
Primarily, much higher margins on refined products like gasoline and diesel. Plus, they benefited from increased capacity at their Pasadena refinery in Texas after finishing up that LTO project.
Right, so explain that downstream buffer effect again for listeners. How does it work when crude prices fall?
Yeah, is why being integrated is so valuable. When crude oil prices drop sharply, that's the main input cost for refineries, so their costs go down. But the price of the output, gasoline, diesel, jet fuel, often doesn't fall as quickly or as far. That gap widens the refining margin.
So they make more profit on each barrel they process.
Exactly. It cushions the blow from the lower prices hitting the upstream segment. It's a natural hedge within the business.
Okay, so strong market margins helped downstream, and you mentioned internal cost savings earlier too.
Yep, that structural cost savings program is clearly bearing fruit. They said they've captured about $1.5 billion in annual run rate savings so far.
That's significant.
It is. And they expect more benefits to come through in the fourth quarter. So they're not just riding market waves, they're actively cutting their internal costs too.
Okay, that covers Q3 performance. Now, let's look ahead. What are they telling us about the fourth quarter, Q4 2025?
Well, the headline on production is pretty positive. They expect full-year average production growth to hit the top end of their guidance range.
Which is what again?
The 6% to 8%.
Yeah.
And importantly, that's excluding the Hess contribution.
Yeah.
That's purely the organic growth from the legacy Chevron business.
So strong underlying momentum continuing.
Looks like it. Add Hess on top of that strong organic growth, and the total volume picture looks robust heading into year-end.
But there are always some puts and takes. What about planned downtime or other charges expected in Q4?
Yeah, there are a few things to flag. On the upstream side, they expect about 125 MBOED of downtime. That includes some planned maintenance at TCO.
Okay.
Then in downstream, refinery turnarounds and downtime are expected to hit earnings quite hard. They're forecasting a charge between $400 and $500 million for the quarter.
And does that $400–500 million include the impact from that fire at El Segundo?
It does, yes.
Yeah.
They said that range is inclusive of the estimated impact from the fire. And then there's the all other segment that's corporate charges, financing costs, etc. They expect an earnings charge there of between $6.9 billion and $1.1 billion for Q4.
Quite a few charges expected then.
Yeah, some headwinds. But even with those, they're keeping the share buyback program going strong. Guidance for Q4 is $2.5 to $3.2 billion in repurchases.
Still returning significant cash. And looking a bit further out, they've got that Investor Day coming up soon, right?
November 12th. Yeah, that'll be important. They plan to lay out their outlook to 2030. Focus is on a consistent, disciplined, and stronger Chevron, according to them. That will give us a much clearer view of the longer-term strategy. #tag outro. So wrapping up Q3. I think the key takeaway is this. They hit a new production record, largely thanks to getting Hess integrated smoothly operationally. They managed the lower crude price environment really well by leaning on those strong downstream margins. And they kept aggressively returning cash to shareholders, all while keeping that underlying organic growth on track. A solid quarter, really, navigating those cross currents.
Definitely feels like they executed well. So here's something to think about as we look towards that 2030 outlook they're promising. You see this huge growth now from integrating Hess, from projects like Ballymore coming online ahead of schedule. They're clearly still investing heavily in traditional oil and gas lick at the recent sanctioning the Hammerhead project in Guyana. The question is, how much more growth runway is really left in those traditional areas? At what point do the newer, maybe currently smaller ventures like that ACS green hydrogen project, or maybe future low carbon investments need to start becoming the main drivers of cash flow growth as we get closer to 2030? Something to consider is how those signals, the big traditional investments versus the newer energy steps, shape Chevron's real resilience in the face of the global energy transition push. Okay, let's leave you there. This has been a deep dive into your sources.